What's up, everyone? Welcome to another parallel lending video. Thanks for tuning in and watching. This is our third video, and today we're going to be talking about how to mitigate risk part two. We did an episode on this, the last episode, and we talked about a few different ways to do it, but we want to go on part two. But before we dive into it, I'm your host, Stephen Hamner. I'm one of the original investors in parallel lending, and I am contributing in the investor relations side of things. Then we have Eric Boschart, who is a co-founder and does a lot of the underwriting and just a lot of the day-to-day basis and processes for parallel lending. So last week or last time we put this video out, we talked about how to mitigate risk in two different ways, right? We had the fact that Eric and Alex, the co-founders, walk the property and they limit or they give draws, or they have construction loans. They do it in draw. So once everything is completed, we know a roof is done, then they send over that X amount, and that's a way to mitigate risk. So today we're going to talk about a few different, other reasons how we mitigate risk. And again, I do want to say before we get into it that there's a lot of other ways we go about mitigating investors and just our own capital, and that is involved in the underwriting process as far as making sure borrowers have some of their own cash in it. We have different parameters that we check, right? So this is assuming that the borrower checked all these parameters in the underwriting process, and these are other additional ways to mitigate risk. So Eric, I'll let you go ahead and take over and talk about these other 2-3 ways wherever we want to get into of how we go about in protecting the capital that's lent out.
Yeah, no, I appreciate that. I think I think insurance is something that is really overlooked in the industry because it's not used a lot. People don't have to file a lot of claims. Lenders don't have to file a lot of claims when if they have to take over a property. We've never had to file any claims. We've never had to take over a property before. I think if we grow, as big as we want to grow, and we stay in the game as long as we want to stay in the game, it will happen eventually. But I do want to talk about a couple of different types of insurance that we can put on the properties that we're lending on to kind of help mitigate our risk. The first one obviously is property insurance. And there are a couple of different policies that we can require the borrower to take on. There's a policy called builder's risk. And a lot of insurance providers, like the major ones that you might think of, like Allstate and Progressive and State Farm, they don't offer builder's risk. It's kind of a more niche product. And builder's risk is really just making the insurance provider aware that there's some heavy rehab component to the property. And so if anything goes wrong with the rehab component, and an insurance provider walks in, or a claim adjuster walks into the property after filing a claim, they're going to know that, there was, a renovation, component to this property. Other policies are really just called like vacant dwelling policies or rental dwelling policies. If there's light rehab, not a lot of things can go wrong during the rehab process, we'll just require that. But the coverage limit has to be at least 100% of our loan amount, which even if we keep the construction portion in our bank account, we're still going to be able to file a claim for the full, for the full coverage limit. So if it's $200,000 loan, the coverage limit will be at least $200,000, and we require the borrower to pay at least 6 months of the policy upfront at closing, and that just kind of gives us some added security. If they're paying by month and they don't have it on auto payment, they might accidentally, have a lapse in coverage. And then, what if in that, small window of a lapse in coverage, something bad happens to the property? We're kind of left out in the yard, so to speak. So we definitely want to make sure that they're paying their insurance on time. So that's why I require such a long, half the term of the loan paid up front at closing. And then, obviously we add ourselves on the policy as a mortgagee. So if the borrower walks away for any reason, and we have to take over the property, we also are able to take over that same policy, enact our mortgagee clause, and file a claim on behalf of the borrower. So that's just kind of some added security there on just kind of home insurance policies. We also have, flood insurance. We always check the FEMA flood map. If it even has a 1% chance in the next 100 years that there will be a flood, we require flood insurance. that is flood insurance is 100% earned, meaning you have to pay the policy in full, and it's not refundable unless you sell the home. So we're covered on flood if anything were to happen. And in Texas, that happens. So if we decide, that we want to, provide a loan in Houston or somewhere like that, we definitely are requiring flood insurance pretty much without even having to look at the flood map. The other part of insurance is title insurance. And this is something that, this isn't legal advice. You should definitely, consult with kind of a title attorney. But we really like getting title insurance. We try to get extended policies to the extent that they're available. We check our title reports, and basically what a title report is just describes the property, and it's a list of the kind of the liens and the exceptions to the rights of the homeowner when they're getting this property. So we're able to look at a specific schedule of the title report and see if there are any outstanding liens or any outstanding judgments on the LLC that owns the property, or on the property itself, if there are any tax liens, any mechanic liens, any other type of government liens. So these are really important to check. Some lenders don't check them. I've seen this happen a few different times. I'm part of some lending communities where they just didn't check the schedule, and so their lien is now subordinate to some mowing lien for $1,000, and then now they're in second position, and that now their ability to foreclose is kind of at risk. So definitely checking title insurance. Definitely have those insurance policies both for the owner and for the lender. The last thing that I'll mention on title insurance is there are liens that pop up during the closing of the loan. The title insurance policy covers you to compensate you for not being in first position anymore during the closing of the loan. So there's a lot that you can get into with home insurance, with flood insurance, other disaster insurance, title insurance. But these are things that we all require. And I think the borrower is walking away from a property or adding liens to the property when they shouldn't. We'll be able to kind of take over and preserve our investors' capital.
So just to recap on the insurance side of things, there's like three main insurances that we look for. And maybe if a different specific scenario pops up, maybe some more, but three kind of insurance that we look for, correct?
Yeah, that's right. Yeah, I would say, vacant dwelling / builder's risk policy, flood insurance, and then getting a really airtight kind of TLTA is what it's called in Texas, title insurance policy.
And then one quick question, excuse me, before we end this, I want to keep this short. Going back to the building insurance, the homeowner's insurance, we require the borrower to pay 6 months up front, so there's not a risk there's less risk of them forgetting. What's been our average loan so far? I know we always give a year loan, but what's been the average payout? I know it's been that maybe 4, 5, 6, 7 months range. One, what's been the average? And two, whenever they're coming up on that 6 month number as far as being under the insurance, do we just, hey, you're coming up, hey, let's go ahead and pay for the next 6 months for the rest of the year? Kind of touch on those real quick if you don't mind.
Yeah, I think I'll have to check our pipeline, but I think our average is about 6 months. But yeah, if they're coming due and the loan is still outstanding, we'll require the next 6 months to just pay the full life of the loan.
Awesome. Great stuff. Thanks so much, Eric. And everyone watching, thanks for tuning in and watching again. So subscribe to the channel, like the channel, all this stuff. We just want to put out good quality information, quick and sweet, that can maybe help investors, borrowers, just anyone in the real estate field have a good understanding of this process. So again, thanks for watching. We hope you all enjoyed this video, and then we'll have some more good stuff coming out next time. But until then, we'll see you next time. Peace.